Jill Carey Hall, BofA Securities U.S. equity strategist on this very topic. Hey, Jill, how do you expect the meme stock retail fury trade to influence small caps going forward if we continue to see a lot of money being spread out?
Right. Well, I think to the point just made, these stocks obviously can impact performance over short periods of time, but there's not a huge weight of these stocks within the Russell 2000 or the Russell Mid Cap Index. There's a lot less concentration risk versus in large caps. So the top 10 largest stocks, of which AMC, GME are among them, within the Russell 2000, they're only about 3% of the index. And if you think about the top 10 largest stocks within the S&P 500 large cap index, they're about 30% of the index. So less concentration risk, but certainly these can have impacts on the individual stocks. That said, we don't think it creates broader investability risk to small caps overall. We surveyed investors back after the initial run-ups in some of these stocks this winter, and only about 5% of institutional equity investors that we survey think that this creates long-standing risk to small caps. So most are still willing to invest in the asset class.
Small caps continue to outpace S&P, for example, large cap stocks. Does that continue? How much legs does that have?
We think it continues. We saw some stalling out in performance. Now that started to resume again. And, really, when you think about the recovery within the U.S., we're further along with respect to economic growth in areas like Europe, but we don't really think that's been reflected in valuations. So even though large, mid, small caps across the board have all seen their multiples run up, small caps are still trading at a pretty sizable discount to large caps, about 15%. And historically, they've traded at about 3% premium on price to earnings. So, not really fully reflecting the recovery that we've seen so far. And a lot of the cyclical sectors within small caps are still trading at a big discount to the rest of the index.
So one of the narratives is that if you have higher input costs, particularly if wages go higher, that's going to disproportionately affect the small cap stocks. Is that actually a true narrative? Have you seen anything like that?
Right. Well, I think, if inflation were to continue to see a significant pop, above 4%, we found that can tend to be more negative, more detrimental to multiples within small caps. But, if this current surge is just transitory and we do go back to a more normal inflation environment where inflation is present within the economy, but we're still seeing a recovery and no surge, then, this hasn't tended to be detrimental. And, from looking at historical periods of inflation, like the late 60s, small caps were one of the best performing asset classes. So, I think if we're in an environment where commodity inflation brings about a CapEx recovery, that tends to help small caps whose sales are more sensitive to CapEx. And, looking for stocks with pricing power, areas with pricing power certainly makes sense in this backdrop.
So it feels like the big ball of money, goes into the COVID trades, goes into the reopening trades, and the inflation trades. You mentioned the value performing over growth. What's the next kind of rotation that we're going to see?
Well, I think we still expect value I think we're in an environment where we're mid-cycle in the U.S. We would still expect value to outperform growth. You could see some shifts within that, however. And what I mean by that is earlier on in the recovery, a lot of what worked is really the high-risk, deep value stocks, bounce off the bottom types of investments. And now we're transitioning to an environment where, we could see peak stimulus. Quality value might be a better way to invest at this point. And that's what we started to see play out in performance in recent months. So it's not necessarily the deep value and risk, but higher quality value that could outperform from here.